Imagine waking up to headlines screaming, "Market crash wipes out trillions." Panic ensues, portfolios bleed red, and fear grips Wall Street. But amidst the chaos, a select few investors are quietly smiling, their portfolios surviving and thriving. How? They saw the crash not as a catastrophe, but as the ultimate buying opportunity. They understood that when fear peaks, fortune favors the bold. Today, we're diving deep into the top 5 stocks that savvy investors are eyeing. Right now, stocks poised to turn this market downturn into a wealth-building bonanza. This is your moment if you've ever dreamed of buying low and reaping massive rewards. Let's uncover the gems that could make you rich from the stock market crash. The 2025 stock market crash has sent shockwaves through the financial world. Major indices have plummeted, investor confidence is shaken, and the word recession is on everyone's lips. But history teaches us that every market crash carries the seeds of the next bull run. The key is identifying the right opportunities amidst the rubble. In this video, we'll explore 5 standout stocks that not only weathered the storm, but are positioned to soar in the recovery. Backed by solid fundamentals, innovative strategies, and market resilience, these companies are the ones to watch. So, grab your notepad, and let's delve into the stocks that could transform your financial future. Number 1. Amazon, AMZN. Amazon's share price plunged to $172.61 during the crash, down roughly 35% from its all-time high of $266.83 just 6 months ago. That means a $10,000 investment today would purchase about 57.9 shares, compared with only 37.5 shares at its peak, putting more future upside into your hands. Behind the headline e-commerce business, Amazon Web Services, AWS, still commands a 34% share of the global cloud infrastructure market and generated $94 billion in revenue over the past 12 months. At today's valuation, AWS alone trades at roughly 25 times free cash flow, a discount to its 5-year average of 30 times, even after compounding at an 18% annual rate. Meanwhile, Amazon's total revenue grew 12% year-over-year last quarter despite economic headwinds, and Prime membership crossed 250 million globally, up 20% in the past year, locking in recurring revenue and boosting average spend per customer. Wall Street consensus price targets sit near $260, implying over 50% upside from here. And analysts expect double-digit earnings growth through 2027 as international expansion and advertising margins continue to improve. Number 2. The Trade Desk, TTD. The Trade Desk stock, now trading around $50.22, is down nearly 40% from its 2024 highs after a broader sell-off in ad tech names. However, the company grew revenue 28% year-over-year last quarter, reaching $332 million, and boasts an operating margin of nearly 23% up from 18% 2 years ago, underscoring improving profitability as it scales. Its platform processes over 1.5 billion ad bids per day, leveraging AI to drive a 15% higher return on ad spend for clients compared to traditional ad networks. Industry forecasts project global digital ad spending to rise from $620 billion in 2024 to over $900 billion by 2027, giving the Trade Desk a total addressable market (TAM) exceeding $200 billion. Based on a forward PE of 40 times, below peers trading at 50 times, the stock is attractively priced for long-term growth. If ad budgets shift further into programmatic channels, a move back to a 50 times multiple could propel the share price north of $75 over the next 18 months, representing a potential 50% gain from today's levels. Number 3. Taiwan Semiconductor Manufacturing Company, TSM. TSMC shares at $151.82 offer a direct stake in the explosive growth of semiconductors powering AI, 5G, and automotive chips. As the world's largest dedicated foundry, TSMC processes over 60% of global logic chip wafers. Last year, Its capital expenditures totaled $36 billion as it ramps up 3-nanometer and begins 2-nanometer production. An investment fueling a projected 20% annual revenue growth through 2026, when global semiconductor sales are forecast to hit $600 billion. Despite a cyclical downturn, TSMC's trailing 12-month free cash flow margin remains robust at 45%, enabling steady dividend increases, currently yielding 2%, and share buybacks of $15 billion last year. Analysts at Credit Suisse peg a fair value of $240 per share by late 2026, implying over 50% upside, driven by continued share gains in every new process node and capacity expansions in the US and Japan. Number 4. Uber Technologies. Uber. Uber's diversification into ride-hailing, food delivery, Uber Eats, freight, and autonomous vehicles has helped it report 18% year-over-year gross bookings growth even as overall mobility demand fluctuates. Trading at $75.24, Uber's current enterprise value of $85 billion represents just 3 times annual bookings of $30 billion, below historic trough multiples. The company's take rate, revenue as a percentage of gross bookings, has climbed from 19% to 22% over the past 2 years, boosting adjusted EBITDA to $5.4 billion last year. Autonomous vehicle trials in San Francisco and Miami show cost reductions of up to 15% per trip, which could add $2 billion to annual profits once scaled. With analysts forecasting 15% annual revenue growth through 2027 and a path to positive free cash flow by 2026, Uber could trade back toward a 5 times bookings multiple, pushing the share price toward $120, nearly 60% above current levels. Number 5. Alphabet. Google. Alphabet stock at $151.16 remains resilient despite a broad tech sell-off. The core Google search business generated $160 billion in ad revenue over the past year, a 9% increase despite macroeconomic pressures. YouTube ads added another $35 billion, growing at 20%, while Google Cloud, though still losing money, saw revenue jump 29% to $46 billion. Alphabet's trailing 12-month operating margin stands at 29%, and it holds over $100 billion in net cash, enough to underwrite next-generation AI research and hardware initiatives without relying on external funding. With the company investing $20 billion annually in AI and owning a 20% stake in OpenAI competitor ventures, many investors view Alphabet as the best pure-play on AI infrastructure and applications. If cloud margins improve from 10% to 15% over the next 2 years, and ad revenue growth re-accelerates post-recession, consensus price targets near $200 reflect 30% upside, translating into substantial returns for long-term holders. The 2025 market crash has undeniably tested investor resolve. However, history favors those who see beyond the panic and identify growth opportunities. The 5 companies we've discussed today exemplify resilience, innovation, and strategic foresight. While no investment is without risk, these firms offer compelling cases for long-term value appreciation. Remember, successful investing isn't about timing the market, but time in the market. By focusing on fundamentally strong companies during downturns, you position yourself for substantial gains when the market rebounds. Stay informed, stay patient, and let your investments work for you. Thank you for joining us in this deep dive into potential post-crash winners. If you found this analysis helpful, please like, subscribe, and share with fellow investors. Together, let's navigate the markets with confidence and strategy.